Welcome to this further insert in our valuation series of videos in which we focus on various valuation related topics falling within the learning area of valuations at UP in the PGDA course, specifically in the module Financial Management 705. Now in this particular insert we're going to have a look at the valuation of a convertible instrument, which in essence is a hybrid or compound instrument, and that tells me immediately that there are two separate parts having two distinctively different values given their distinctively different characteristics. Now before we get into the nuts and bolts of doing the valuation of the convertible instrument, I would like to take you back to basics initially, and that we have a look at what a convertible instrument is. Now, this I assume to be embedded knowledge, given that we had a look at this during our financing lectures. And at that point in time, we said a convertible instrument is an instrument which initially has either attributes of debt, or if it is a preference share that is later convertible into equity, there will be typically a fixed coupon preference dividend payable. But at some point in future, this debt instrument or preference share is then converted at, please note, a predetermined rate. In other words, this conversion rate that I'm going to talk about now is set up front before the issuing of the instrument initially, and that this conversion may or will take place. Now, I'm going to talk in the point below when I talk about the issues that you need to pick up out of this definition. And one of the takeaway points here is and that's what I was implying there, is that the conversion could be a mandatory, in other words, you can only convert, or it could be optional. And where the conversion is optional, the right to decide as to whether to convert, the other alternative would then be to have the instrument redeemed, will either resort with the issuer, in other words, the company issuing the instrument might have the right then to decide as to whether to redeem or convert the instrument, or the holder of the instrument will retain the right to decide. On the future date, we refer to that date as the conversion date. If it's a mandatory conversion, conversion will take place automatically. If it is optional, then, as I mentioned to you, either the holder or the issuer will have the right to decide whether to convert at that predetermined conversion rate. Now you will remember that the issuer will always try to limit the dilutionary effect of this conversion by setting the conversion rate relatively low, and in doing so building in what we said under financing was a conversion premium. And that limits then the dilutionary effect, which for the existing shareholders of that company would be viewed as being quite negative. Now, what are the important issues I'd like you to take from the definition? Well, firstly, as I mentioned earlier, a convertible instrument is what we would term a hybrid instrument, and in terms of IAS 32, it would be seen as a compound instrument. Now, we in financial management are not going to deal with the initial measurement of a hybrid or compound instrument. Now, IAS 32 has specific requirements about the initial measurement of the instrument in terms of the debt and how we would, if it is a convertible debt instrument, and how to determine then the value of that debt, with the residual or the leftover portion of value then being assumed to be the equity. We're not going to delve into that. We are specifically in this video clip going to have a look at determining a fair value for the debt or preference share portion. I'm going to look at an example that uses debt in this scenario, in this particular video clip, and we will have a look then at how we determine a fair value for the equity portion. Now, these takeaways, as I've referred to them, can also be considered to be key considerations. And so what I would like to point out to you at this point now is that in any environment or scenario where you are confronted with a convertible instrument, it is crucial that you be on the lookout for whether it is a mandatory conversion at the future date, in other words, a conversion date, or whether the right or decision to convert resides with the issuer or the holder. Now, why is that such a critical point to pick up on? Now, where we have a mandatory or compulsory conversion, then we don't have to measure whether the holder or issuer is going to firstly want to have the instrument redeemed or whether they will elect to convert it. We know there is only one particular outcome. But where there is an option involved, other than knowing who holds the option, in other words, who has the right to decide what is going to happen, but we will need to measure based on value. We will need to do a valuation here of the redemption alternative. Separate to that, we are going to have a look at the conversion alternative. And then, before we decide on what's going to happen, we will reflect back on who has the right to exercise that option. In other words, is it the issuer who can decide? Because if that is the case, they will always want to take the least expensive alternative. In other words, they want to minimize the outcome, which would be that should the conversion alternative have a lower value, they would elect then to convert, or if the redemption alternative was to be the cheaper one, they would elect to redeem. Now, where the holder has the right to decide whether to convert or redeem, they will always want to maximize the outcome for themselves and therefore select the alternative with the higher value. So that is very, very key, please, that you know or look for who has the right, if it isn't mandatory, to decide whether to redeem or convert the instrument at that conversion date in future. Now, as I said to you, conversion takes place at that future conversion date. Now, before we get too involved as regards to what the value is on that future date and the need to discount it, let's first stand back and consider what happens at conversion. Now, if we are dealing with a debt instrument initially, the issuer will have to pay finance costs or incur finance charges that they will pay to the holder. And so when conversion takes place, the corporate issuer ceases paying the finance charges. Now, on the one hand, although they cease paying the finance charges, which is a positive aspect, they also lose any tax deductions linked to those finance charges. And so that, I suppose, could be seen as a downside. If we are dealing with a preference share, which is later convertible into ordinary equity, the issuer would be paying preference dividends during the life of that instrument, and at conversion, those preference dividends cease. So whether we are talking here about interest being paid on the debt portion or a preference dividend being paid on the preference share portion, as soon as the instrument, well, it would be the same as if it were to be redeemed. But as soon as it converts, number one, that expense stops. But at the same point in time, when conversion takes place, not only do we save on the after-tax expense where applicable, but the company now issues additional ordinary shares. And so it is very possible that at that point in time, we are going to see a dilution occurring. Now, from a financial reporting perspective, I just want to stop here for a minute. As soon as the company has, one issuer has a convertible instrument in issue, IFRS tells us that we need to calculate not only a basic and a headline earnings for the issuer, but we need to indicate if conversion did take place, what the impact on the key indicators being earnings and dividends would be. Now, from a corporate finance perspective, we are going to use those indicators in valuing the equity portion here, but we'll come back to that a little later. Now, that is in essence what happens. At conversion, two very key things happen, just to recap. Number one, the issuer will stop incurring the expense that they have been incurring up until that point, whether it be the finance charges after tax that will be saved or the preference dividend that will no longer be incurred. But at the same point in time, at conversion, the issuer will now issue additional ordinary shares, which that convertible then converts into. Now, the second key consideration here is that you please have a look at how large the equity stake being obtained at conversion is relative to how many shares there will be in issue at that point in time. Now, why would we be interested in that issue? Now, I need to consider whether I am valuing a controlling or a non-controlling stake here, because it could impact on the valuation methodology that I'm going to use. Now, before we go any further, do you think that corporates would issue convertible instruments that at conversion, the holder of that instrument would be allocated or allotted so many ordinary shares that through merely converting that instrument, they then would seize control of the company, its operations, and through that being able to affect the value of the operations or the company and the equity of that company? So it is highly unlikely that at conversion so many shares would be allocated to the holder of that instrument that through conversion on its own they would get control. So normally in isolation, that stake in the ordinary shares that the holder becomes entitled to would be a non-controlling stake. Now, as a knock on to that, I said to you, think very carefully. Firstly, before you think, look, does the holder of the instrument, the convertible instrument, hold ordinary shares in this company already? Because what the result might be of a conversion is that where that holder currently does not have control, they might well get control through the conversion. And then we would sit with a few interesting dilemmas when it comes to evaluation. Right, but remember, they don't have to pay anything for the conversion. So where it is going to become tricky is where the holder has shares already, number one. They hold a convertible instrument through which they're going to, should they convert, be allotted additional shares. And on top of that, they are looking at buying an additional stake in that company. You then could have a very interesting dilemma when it comes to the potential for a change in control. And in that case, as I said to you there, and luckily one of the questions in the question pack is going to test this. In a case like that, where the shareholder has not only a stake in the ordinary shares, they also own at least part of the convertible instruments in issue. They are going to convert that instrument or those instruments that they hold into ordinary shares, and they are looking at buying an additional stake. That additional stake for any other buyer, listen carefully, could be seen to be a non-controlling stake. But when we look at the accumulation of control through the conversion, and on top of that acquiring additional shares, this shareholder might get control of the company through this additional stake they're buying. Then we sit with the need to determine a minimum and a maximum value here. In other words, a range of values. Because that shareholder, who is also the holder of the convertible instrument, through buying that additional stake, which on its own is non-controlling, will be able to enhance their control. That means they would associate more value with that than any other buyer of that stake would. And that justifies what I discussed with you in the earlier series of videos, that where there is an enhancement in control for a particular buyer only, not any buyer, but a particular buyer here, then there is a need to determine that range of values. And then, as I said to you earlier, because the conversion and the ordinary equity obtained at that point in time takes place somewhere in the future, we will normally need to take, if we were to value the shares at that point in time that they become entitled to, we would need to discount that value back to today, which is valuation date. Right. And so just to reiterate, please be very careful that you look very carefully in a scenario as to whether the holder of this instrument has any shareholding prior to conversion already. There's the first sign that things could get sticky and difficult here. And definitely, if you see that and you know that the holder is now considering buying additional shares and the holder is going to convert, then you need to tread very carefully around whether or not this holder of the convertible instrument is going to be able to obtain control within the company. And then we sit with the problem from a valuation perspective. Now, I firmly believe that you need to have a timeline on which you indicate the various key milestones in the life of the convertible instrument. And so, as I pointed out to you on this slide that you have in front of you now, in the life of a convertible instrument, you will have various key milestones or dates. The first will be the initial issuing date or issuance date of the instrument. And that's important because relative to that date, the conversion or redemption date will be set. So as I said to you at the start there, it's very important before we consider this timeline to look at whether that conversion is mandatory, or at that future date, or maybe at a different date, instead of converting, the instrument could be redeemable. Now please remember that where these dates differ, the conversion versus redemption, if there is an option, that is going to have a very key impact or a very profound impact on our valuation, because we will be dealing with different periods of time, and that has a discounting impact. Now, be careful whether you are valuing the instrument at its issue or whether you're valuing it beyond its issue. remember, when you're valuing it beyond its issue, you are only looking at all the future cash flows resulting beyond valuation date. And so, where that is the case, some of the cash flows would have already taken place, where the issue date preceded the valuation date, and we would ignore those cash flows, those historic cash flows, as they are not future orientated. So it is important to see where the valuation date lies. Now, up until conversion, and I called it the period to conversion, the company will, depending on whether this is a debt instrument, then they would be paying interest on it. They would probably be getting a 24J tax deduction on it. But or not a 24J, I think it's a section 8F. But whatever the case, there could potentially be tax consequences here, and you would need to be very careful as to whether, and I'll get back to that just now, whether to take that into account or not. So up until conversion, the company will either be paying, if it's a debt instrument, finance charges, and as I said, please be careful of the tax consequences of that, or they will be paying, if it's a convertible preference share, preference dividends on the instrument. Now, at conversion, when the instrument converts, the issuer ceases having to pay that expense on the instrument, and so there's the first key change happening. In addition to that, the instrument that was a debt instrument and therefore would expose the holder to the risks that any debt funder would be exposed to. If it was a preference share, then the risks that the preference shareholder would be exposed to, that holder is now transformed into a ordinary shareholder who has very different risks. Remember, as a shareholder, when you are exposed to equity risk, you are exposed to a lot more downside because you have no preferential rights should that company collapse to getting your capital back, and you also stand right at the back of the queue in terms of getting any return in the form of a dividend. So, very, very key. Up to conversion on that instrument, the company will be incurring some or other cost. There could be a tax consequence, as I said, and you need to be able to factor that in because we're going to place a value on those cash flows just now. At conversion, that expense ceases, any tax advantage is lost, but at that point in time, the company now issues additional shares. And as I said to you earlier, those additional shares being issued can result in a dilution. Now, on that score, as I said to you at the bottom of that slide there, please take note that from a corporate finance perspective, the fact that IFRS says where you have a convertible instrument in issue, the issuer has to, in their financial reports, not only disclose a basic and a headline earnings figure per share, but the issuer also has to indicate or calculate and disclose a diluted earnings per share. And from that, as I said to you here, we can also determine a diluted dividend per share. Now, this is going to be very, very key. From a corporate finance perspective, we are going to use, and we'll talk about it just now, depending on whether it's a controlling or a non-controlling stake, we will use this either the diluted EPS, the diluted earnings per share, or the diluted dividend per share as the basis of our valuation of the ordinary equity component of this compound instrument or hybrid instrument. But more about that when we apply that indicator and value it in our example that's going to follow quite shortly. Now, before we move on, just one key, very, very key point. please remember that the holder of that convertible instrument before conversion will not be entitled to that diluted EPS nor the diluted DPS. Now this factor is going to cause havoc just now in the example we're going to look at. So please, this is one of the most important issues that you've got to pick up on as we enter into the example shortly, which will then clarify the valuation issues. Please remember that before conversion, the holder of that instrument will not be entitled to any returns that the shareholder holding a stake in the equity of the company would. Only beyond conversion do I, as the holder of that convertible debt instrument or convertible preference share, do I have a right to the earnings and the dividends relating to those ordinary shares. Now, in explaining the nuts and bolts behind the valuation of that debt or preference share portion of the convertible or hybrid or compound instrument and the ordinary equity portion, I would like to do it using the following example. So let me read the example together with you. AB Limited has just issued 10,000 convertible debentures, right? So let's stop there. What have we got? 10,000 units of a debt instrument, and it's convertible. We don't know yet mandatory or optional. Each instrument has a nominal value of 100 Rand. Why is that important? What does that trigger? That tells me any interest, because remember it's a debt instrument initially, so we're going to pay interest as the issuer, will be paid on the nominal amount. Now, interest is paid annually in arrears. That's important from a valuation perspective, at a fixed coupon rate of 9% per annum. In other words, because this isn't a floating or a variable rate, it is very easy from a valuation perspective to value this instrument because we have a constant equal amount annually that will be paid. Right, and if we do any valuation here from the issuer's perspective, we're going to assume that the issuer here would be entitled to a 24J deduction on the convertible instrument, on the debt portion. Right, now, very key, a market-related rate, a reasonable market-related rate for a similar convertible debenture is 10% per annum. However, for a straight debt variant on this, in other words, should this instrument have been redeemed, then that holder of that instrument would expect a 10.5% rate of interest to apply. Now that's important. So when you are valuing the redemption alternative, if there is one here, we would do it at 10.5%, while the convertible instrument would be valued at the 10% rate. Now, conversion is set to take place 5 years from now. Very, very key. At the choice of the holder. So let's just stop there. So ladies and gentlemen, very crucial here. It's not a mandatory. There's an option here, which means that the holder in this case can either redeem or convert. And they will choose whichever of these two alternatives is the most feasible from their perspective in wanting to maximize the value of the instrument. Now, a little bit further on there, you will see that the conversion rate, which has been set in advance, is that each of the convertible instruments will convert into 9 ordinary shares. In other words, if I hold one debenture, I am entitled, should I elect as the holder, to convert into ordinary equity to take up 9 shares at conversion. Right. Should the holder, however, decide not to convert but rather to redeem, then the instrument will be redeemed on redemption date, being conversion date is for those who elect to take up the shares, rather, if there are any, but redemption and conversion date are identical here. Now, what additional information are you given? Firstly, you are told here that AB Limited has 100,000 ordinary shares in issue at present. Now, the question at this point that I'd like to ask you is how many additional shares should conversion take place? We don't know yet whether it will or not. But if it was to take place, how many additional ordinary shares would be issued? And so we have 10,000 convertible instruments in issue. They each convert into 9 ordinary shares, so we would have to issue 90,000 additional ordinary shares. Now, why is that important? What does that trigger here? This triggers me to go and determine whether those 90,000 shares on their own would create control, and the answer is no. There will be 190,000 ordinary shares in issue at that point. 90,000 will be issued to the holders or holders of the instrument, convertible instrument, and so 90 of 190 is less than 50%. So they are not controlling. So we can justify using which valuation method there, because it's non-controlling, a dividend approach. So when we get to the solution just now, and you start seeing dividends being valued, it's for that reason. Now, the most recent earnings is 400,000 Rand, and the board maintains a dividend cover of 4. So if I take earnings and divide it by 4, I get dividends. Very important principle. And then, what valuation rates have we been given? The cost of equity of the ordinary shares of AB Limited has been derived. It's not a listed company. This has been derived for AB Limited, and that is a KE of 21%. But we are also told that the future dividend growth will be 12%. Now, and we will also assume a growth in earnings here of 12%. Please just make a note of that. The assumption is both a growth in earnings as well as dividends of 12% per annum and a tax rate of 28%. Very important. We have KE, 21%. We have G, 12%. Do we have the dividend yield here? I want you to think about that. Now, we don't know whether the holder of this instrument will elect to convert or to redeem the instrument. That is, in fact, what you've got to go and calculate here. Now, on the one hand, we will need to work out what the value of the instrument would be should we decide to convert, versus what would it be if we chose the redemption alternative. And so to start off with, because that's the easier of the two, I would like to focus quickly on how we would value the redemption alternative. Now remember, redemption entails the capital being repaid, and we therefore consider that alternative to reflect a straight debt alternative here. In other words, beyond the issue of the instrument, you pay interest, and at redemption, the capital, and in this case, its nominal value of 100 Rand per debenture is paid back. So, we have, for a 5-year period, up to redemption, and remember, redemption and conversion are the same or the identical date, 5 years from now. They would then be repaid the nominal value per debenture of 100 Rand. Up until that point, they would get 9 Rand per annum. That's what the holder would receive. The corporate issuer would be paying that. And very interesting, a pre-tax payment at a pre-tax rate here. Now, why have I used a pre-tax rate here? When we determine a fair value for the holder of the instrument, what principle are we applying? Now, what you should remember from your earlier videos on valuations is that when we talk about fair value, we are looking at it from any participant in the market. And the problem is, from a tax perspective, with a fair value, we don't know what the tax rate of that investor in the market would be. Hence, we can argue then that when we calculate fair values for the holder, we don't know what their tax rate is, and because of that, we work pre-tax payment, pre-tax required rate of return. So the 10.5% is pre-tax, as is the R9. Now, why do we use the 10.5% here? In the scenario, it says a straight debt alternative requires a 10.5% return, whereas the conversion only a 10% return. And that gives me a fair value of R94.39, and that is, should the instrument be redeemed, then the value of this straight debt alternative would, per debenture, with a nominal value of 100, would be a fair value then of R94.39. Now, as I said to you there, just beyond that, the little money key there at the bottom says, like, dude, how would this have differed had we had the issuer held this right here to convert or to redeem? In other words, we then would be looking at it from the issuer's perspective, and in that case, there is only one issuer, and remember, they have an identity which that identity list participant in the market doesn't. And so where we are looking at from the issuer's perspective, we would take the issuer's tax rate, and in this example, it is 28%. So here it's very different. The payment now becomes after tax, so the R9 after tax becomes R6.48 per annum, and we now need to adjust the rate that we're going to discount at. And so that is that market rate, the market-related rate for a similar debenture, which is redeemable at 10.5% after tax, is 7.56, and it gives me a slightly higher value of R95.64. Why the difference here? And the difference is the capital being redeemed is not tax deductible, but we are discounting it at a lower rate. And so we're making an assumption. We're working with after-tax cash flows here at an after-tax rate. Right. R95.64. So there is a slight difference there, but at least we know why it occurred. So just to confirm, and that's why I've given you that little block there, that when we are looking at fair value, it's very important if we are looking at it in a scenario where the holder has the right versus the issuer having the right, then it can be very, very different. And so remember, fair value from the holder's perspective, please just make sure that you have that in front of you there. From the holder's perspective, we don't know what the holder's tax rate is. We know what the issuer's tax rate is. That is why, as I said to you earlier, it is pre-tax payment, pre-tax discount rate. Now, there are three approaches that we can take to valuing, in other words, to determine the fair value of the equity portion of a compound instrument. So in the tree, or in the decision tree below, that tree diagram, I've set you the first two approaches, and one, in fact, one of those approaches, the first one becomes two, as you will see just now. The two main approaches is we can either value the equity now and adjust that value for the time to conversion. I'll come back to that later. Or we value the equity at conversion and bring it back to a present value today, being valuation date. So these are two very, very different approaches. So just to reiterate, the first one being value the shares now. Adjust for the time to conversion, and I'll talk to that in a moment. Or value the shares at conversion, but because that's in the future, I need to present value that value, and we'll talk about that later as well. So what I'm going to start off with then is to look at determining the value of the ordinary equity immediately now, although conversion has not yet taken place. Right, that is very, very important. In our example, conversion is only set to take place 5 years from now. And so if I value those shares as if conversion has taken place already, I've got a problem. And I want to put that on the table now already. And we're going to have to resolve that problem when we hit it just now. At the end, I will show you the alternative approach, which is to value those shares at conversion. So let's start off then by looking at valuing them now. Value the shares now as if conversion has already taken place. Now let's stop there. What accounting or financial reporting indicator did I say any issuer of a convertible instrument will need to disclose? That's right, the diluted EPS and diluted dividends per share if the company has declared dividends. Now, if that is what needs to be calculated, then my question to you is, can we not use those indicators to do a valuation with them? And we might well then do that. So just remember that those two, the diluted earnings and diluted dividends, are two indicators or metrics that financial reporting standards say you have to calculate where a convertible instrument is in issue. And we will seize then on them because they are available. Now, we will then hit a problem just now, and the two different approaches then that I will show you to the very right on this slide is what we will need to consider in terms of how we deal with the problem. Now, as I said to you, if we value those shares as if they were obtained now and not on conversion date, I have a question for you, and that is, are we as the holder of the convertible instrument entitled to that stream of earnings or dividends that we are entitled to that would be received by the holder of that share? Are we as the holder of the convertible instrument entitled to those dividends and earnings from day one onwards? And the answer is no, only from conversion. And so I'm going to show you two methods which allow us, listen carefully, to strip out those dividends or earnings that we are not entitled to yet. Right, and I'm going to focus with you on stripping out the dividend portion. Right, And I'll show you the two techniques that we can use to do that. So just to remind you what I said earlier, and there is a very nice interface here between the valuation technique we're going to use here and what you would do in a financial reporting environment in terms of calculating diluted earnings and dividends per share. So, as I said to you, from conversion onwards, the issuer stops paying the return that they had been paying up until that point to the holder of the instrument. In other words, if it is a debt instrument, the company ceases paying the interest and they lose the tax benefit. If it's a preference share, the preference dividend is no longer paid. Now, in our example, we have a debt instrument that is convertible. So, remember what we're doing here is we want to calculate a DEPS, in other words, a diluted earnings per share, and derived from that a diluted dividend per share, and to value those. Now, from a financial reporting perspective, you need to go and make the following adjustment. And that is, here we assume that after conversion, this instrument will therefore no longer be an issue, will not be replaced, and so the company has a permanent savings with regard to those finance costs that it would have incurred. So on the 10,000 instruments, right, of 100 Rand each, they will be paying a 9% interest rate and will be getting a tax deduction on it. Now that results in an annual saving. Remember, the interest is fixed, so it's not going to fluctuate. An annual savings after tax of 64,800 Rand. That results in adjusted earnings figure of 464,800 Rand. Now we are going to seize onto that and use that to calculate the indicators. So remember, we are assuming here for the calculation of the indicator that conversion takes place, the savings is made, but now we also assume that the additional ordinary shares are issued. And so you will remember from the information, we had 100,000 ordinary shares in issue. We need to issue 9 ordinary shares per debenture. There are 10,000 of them, so an additional 90,000 shares will be issued, and that results in 190,000 shares being in issue. That divided into the adjusted earnings gives me a diluted earnings per share of 2.44 Rand rounded, and a diluted DPS of 61 cents rounded off. Where does that come from, the 61 cents? Remember, in the information you are told that the company's board adopt on a continuous basis a dividend cover of 4. That is what they maintain. Now, as I said to you earlier, a company will typically have as indicators earnings per share, basic, derived from that a DPS. We will have a headline earnings, and we will now have a diluted earnings per share and a diluted dividend per share. Where or in what does the value lie? Now, the first 2 that we are going to discard here will be my DPS and my EPS. Now, why do we discard those 2? Remember, basic earnings per share and headline earnings per share, as well as DPS, ignore the impact of the additional shares that will be issued on conversion, and it ignores that savings, that 64,800 Rand. So what we are going to be interested in then will be the diluted variations on the theme. Right, and so as I circled those two indicators there, so let's go and calculate them. So the 464,800, as I said, divided by the 190,000 gives me that R2.44. And as I mentioned to you earlier, that divided by 4 gives us the diluted dividend per share. And we will be interested in both of those indicators when we get to the valuation shortly. Right, now what valuation indicators do I have? Well, in the information, I have been given a cost of equity of 21%, and I've been given dividend growth and earnings growth of 12%. Right, so I've got G and I've got KE. What does that tell me? Should I want to value a dividend, I could use the dividend growth model, D1 over KE minus G. Have I been given a dividend yield here? And the answer is no. D1 will always relate to KE minus G or vice versa. KE minus G is used as the valuation metric to value, or valuation technique, to value D1. Dividend yield we will always use to value D0. We're dealing with two very different approaches, and that we're going to work with now. Now, as I said to you on the earlier slide, one approach is to value the shares as if conversion takes place now. And so very, very key is, I said to you at the top there, the first approach has as a common starting point, what would the shares be worth now if conversion took place now? Now, what I would like us to start doing is to have a look at the first text box on the left at the top. Now, as I said to you there, the information you've been provided with provides you with firstly KE, secondly G. Can I calculate D1? And the answer is yes. We've just calculated diluted dividend 0. That was the 61 cents. So surely, if I take diluted dividend 0 and add 12% growth on, I get D1. Now I have KE and G. Surely I can value these shares. Now, do I have the dividend yield? No. Do I have an earnings yield? No. Could I value earnings here? You could consider it, notwithstanding the fact that these 90,000 shares on their own will not be controlling. You could use an earnings yield or a PE here as long as there is no control premium adjusted for in that rate. But I do not have them glaring at me in my face here. Question is, using KE and G, can I calculate a dividend yield and or an earnings yield? So let's move to the right here. Now, very, very key. You learned in third year and in the valuation methodology section in 705 that the dividend yield and the dividend growth model for the same company must surely give you the same answer. So just think about it. Although we're using different inputs, it's the same share, ladies and gentlemen. You have to get the same value. And so I want to highlight that issue for you now. So what I'm saying here is, because the value must be the same, D0, the dividend now, capitalized at the dividend yield, must equal D1 capitalized at KE minus G. Is the dividend yield the same as KE minus G? No, it can't be. You can see that by looking at it. They're different. Why? We have included 1 year's growth in the dividend growth model. If you have a look over there, D1 includes 1 year's growth above the line in the numerator. D0, on the other hand, excludes that growth. Now, to get the same answer, what do we know must be different? The two denominators. Right, so KE minus G will always give you a greater answer. KE minus G in the denominator will always be higher than the dividend yield. Why? The dividend yield is reduced for 1 further year's growth in the numerator, in the denominator below the line. KE minus G excludes the growth in year 1. Why? That growth is sitting in the numerator in D1. So its impact cannot sit in the denominator below the line. So we are dealing with two very different issues here. Be careful. The approaches are different. How? The treatment of that 1 year's growth. Either bringing it into the dividend, as we do with the dividend growth model, or adjusting for it where? Through the capitalization rate. The dividend yield being lower. And remember, when I capitalize or divide by a smaller number in the denominator, my answer that I get grows. So very important is D0 excludes dividend growth for the following year, so that implication I bring into the rate below the line. In Gordon's growth model, or the dividend growth model, that 1 year's growth in dividends is brought into the numerator, and so it's excluded below the line. And that's what you must be on the lookout for just now. Now I'm going to get very technical, so please just be calm and listen to me. What we would call a multiplicative relationship exists between the cost of equity, dividend growth, and the dividend yield. So look at the mathematical relationship which I have given you there. So as I said to you, this is a multiplicative relationship. So 1 plus cost of equity equals 1 plus dividend yield times 1 plus the dividend growth. Very key. We are going to use this principle to convert or work between a dividend yield and KE minus G. Right, so that's a mathematical relationship. Just below that, I have given you, from a financial management and a financial calculator perspective, a more easy approach to understanding this relationship. Right, so in front of you, as I said to you there, alternatively stated, the dividend yield is the present value of KE minus G. Now, why is that the case? From that very first statement there where I said to you, the dividend yield applied to D0 must give you the same answer as D1 over KE minus G. And so what I'm saying to you here now is that the dividend yield is the present value of that 1 year's growth in the dividends that we are factoring into the dividend yield that would have been excluded from KE minus G. And so it's very easy for you to remember then. The dividend yield is the present value of KE minus G that I put in as my future value. When is that going to apply? 1 year from now. It's all about that 1 year's growth in the dividends. So, using a future value of taking KE minus G, 1 year from now, that's the difference between a dividend yield and KE minus G, is an N of 1. What is creating the difference is the dividend growth in that year, G. And so I use G as my discount rate because I'm saying that it is that 1 year's dividend growth which is causing the difference between the dividend yield and KE minus G. And so my I per year for this discounting effect is then the dividend growth. So let's have a look there. So in our example, where you have a cost of equity of 21% and dividend growth of 12%, we have a future value for KE minus G of 9%. That is 1 year from now. So N is 1. The growth in dividends, the I per year is 12%, and applying that to the 9% gives me a dividend yield of 8,03. Right, that is just to the second decimal. I haven't rounded it off in calculating what we're going to have a look at to the left in a moment. But that 8,03, and if I remember correctly, the third decimal is 6 there, is the dividend yield. So we've solved for one of the indicators. We've now got, we can use Gordon's growth model or the dividend growth model, and I can use the dividend yield. Do we have in this scenario an earnings yield? And the answer is no. But the question is, can we derive one? And the answer to that is very simple. For a non-controlling stake, if I multiply the dividend yield by the dividend cover of that company or enterprise, then I must get the earnings yield. And so if I take that 8,036, whatever the decimals thereafter are, percent, and I multiply it by the dividend cover of 4, I get an earnings yield. And remember that we would apply to the historic earnings. And we get an earnings yield then of 32.14%. Right, so using these rates, let's apply them to the indicators that we worked out 2 slides back. So we said we have a diluted earnings per share of R2.44. What would I use to place a value on those earnings? The earnings yield, and that we said was the 32.14%. So if I capitalize the R2.44's diluted earnings at a 32.14%, rounded off to 2 decimals as an earnings yield, I get R7.61 per share. Now, we calculated the dividend yield to be what rate? That 8.036%, rounded it off to 3 decimals. That we applied to D0, and we said the diluted DPS now is 61 cents, rounded off to 2 decimals. So I apply that 8.036% dividend yield to that 61 cents dividend, and I also get a value of R7.61. I'm starting to get a warm feeling here. And then we said, but we can wait a minute, we can also use the dividend growth model. So there I take the 61 cents, which is the most recent dividend or diluted dividend, plus 12% growth gives me D1. But now I must use KE minus G, which is the 21% minus the 12%. What does that give me? That also gives me R7.61. That is on a per share basis. Now, what do we know we, as the holder of this convertible instrument, are entitled to? we are entitled to 9 of these shares. And so 9 shares times the R7.61 gives me 68 Rand 50. Right, now that is the value of that basket of 9 shares, which I'm entitled to at conversion. Take note, there's something sitting in what I've just said that should start bothering you. The 68 Rand 50 is what the 9 shares are worth that you become entitled to when you convert that single debenture that we've been looking at. Have we got a problem here? I want you to think. So clever kid, as I said to you there, who has a light bulb shining, or hopefully going to go on in a moment, has a question for you. What precisely did you put a value on in the valuations that we've just done using the dividend yield, the dividend growth model, and the earnings yield approach? What did you value? We took the diluted earnings and we valued that with a dividend yield, or we took the we valued that with an earnings yield, the diluted earnings, and in doing that we in fact placed a value on that stream of future earnings growing constantly at that 12%. Then we said, but we could also take a dividend, the most recent dividend, and capitalize that at a dividend yield. That too, ladies and gentlemen, is placing a value on the entire stream of future dividends, as you did with Gordon's growth model. Now, what problem do we have here? And the question that Clever Kid is asking you is, Houston, do we have a problem? And what is your answer to the question? We do have a problem here, because you are only, as the holder of that instrument, entitled to earnings or dividends beyond conversion and not before that. So the issue that we have is all 3 valuation methodologies that we used placed a value on the entire future stream of dividends or earnings, including those for the next 5 years. And so we need to do something now to that value of 68 Rand 50 to correct the mistake that we've made. So what are we going to do? We need to remove from that value the next 5 years dividends, which would be the dividends in each year, bringing growth in those dividends in. So I can adjust that 68 Rand 50 value that we've just determined and remove from that the 5 years worth of dividends. Now there are 2 approaches. To the left there, approach number 1, as I've called it, we are going to strip out those 5 years dividends using an opportunity cost as a discount rate. Now, what is the opportunity cost? And there are 2 possibilities. One possibility is that it is the cost of equity of the company. Alternatively, it could be the dividend yield. Now, what do we know is the nature of those dividends that we are not entitled to? They are going to grow. And so I need to remove a growing dividend here. And so when I use a rate as a discount rate or an opportunity cost to discount out those 5 years worth of dividends, Must that rate that I'm going to use be adjusted for growth? And the answer is yes, because the dividends are growing. And so cost of equity is a risk-adjusted rate and only risk-adjusted. What do we know about the dividend yield? The dividend yield is both risk and growth adjusted. And so if I apply that 8.036% rounded to 3 decimals, and I discount those 5 years growing dividends out, remember, when we discount something out of a value, that value that we need to discount, in this case the dividends out of or from, will always be in the calculation a future value. So we place the 68 Rand 50 as a future value. We apply our dividend yield. Remember, it's growth and risk adjusted. The main issue here is the growth in the next 5 years. And I discount out here at 8.036%. The dividends growing over the next 5 years at 12%. Remember, that 12% actually is part of that relationship between the cost of equity, the dividend yield, and the dividend growth. And so I get a value, please take note, of 46 Rand 54 for that basket of 9 shares. Alternatively, approach 2, which might be a little easier for you, says, well, instead of removing by discounting it out of the value using an opportunity cost, why don't I try and forecast or predict what the next 5 years dividends would be that I'm not entitled to and value them. Now, what do we know the diluted dividend per share is now at time point 0? 61 cents. So 61 cents plus 12% growth gives me the 68.5 cents, and I've rounded that off to 3 decimals. That plus 12% gives me the 76.7 cents. That plus 12, the 85.9, and so I go on. And I predict or forecast per share, please note, the next 5 years dividends, factoring growth in where here? Into the dividend. Now, something very, very important. Why do I discount the stream of dividends at a cost of equity here and not at the dividend yield? Now remember, the dividend yield is both risk and growth adjusted. What did we do, ladies and gentlemen, with growth in those dividends there that I've circled? We brought growth into the dividends, and so because we've accounted for growth already in the cash flows here, can I account for growth in the rate as well? And the answer is no, because then I've double counted for growth. And so because of that, what are we going to do? I am here going to discount at solely a risk-adjusted rate, which is cost of equity. That is 21%. That gives me a 2 Rand 44 value per share, times the 9 shares gives me, for that basket of shares, a value in present value terms of 21 Rand 96, which I am not entitled to. It is the fair value of the dividends that we are not entitled to. I deduct that from the fair value of the 9 shares currently, and it gives me a value of 46 Rand 54. And what do we know about that? That is the same value as the value I placed on those shares in approach 1. Now, I showed you in terms of this diagram earlier that instead of valuing the shares as if conversion has taken place now, which is the methods that we've just looked at, I could value the shares at the point of conversion. And so that is what method number 3 is going to look at. Alternatively, approach 2, as I've called it, the second approach. Approach 1 dealt with valuing the shares now, long before conversion on valuation date, and stripping out those dividends out of that value that I'm not entitled to. I'm saying alternatively, value the shares at conversion, but now we've got a problem, because at conversion is somewhere in the future, and I will therefore need to discount that value back again to a present value today. So if I was to draw you a number line, when precisely would we be valuing these shares? Now remember, we went and valued these shares at valuation date based on approach 1. So approach 1, we valued the shares taking the most recent or current EPS on a diluted basis or diluted dividend per share, or we grew that dividend per share for 1 year and then used KE minus G. But all three of the methods we've just looked at valued the shares there where the blue arrow is, in other words, on valuation date. And then we said, but wait a minute, we valued the entire stream of returns. I'm not entitled to the next 5 years' returns. And we removed that dividend value out of the value of those shares. Now, instead of valuing those shares on valuation date being T0, we are going to move forward and value the shares over here. And that is, ladies and gentlemen, valuing them at conversion. Now, look very carefully there. I said we are either going to go and predict what the diluted dividend per share would be either 5 years from now at conversion or 1 year beyond that at T6. And in fact, we can do the same with the earnings per share. A little bit more complicated in terms of valuing it, and I'll get to that in a minute. But we can value, instead of valuing the instrument at valuation date, we firstly value it at conversion date and then manipulate it through discounting it. We discount it back from there to here, which is the valuation date being T0. Now, how do we go about using approach 2 then, which is to value them at conversion? Now, remember, we started off by saying we have an earnings figure, the most recent earnings of 400,000 Rand. And what I need to do is to do a valuation at conversion date. I've got to grow those earnings and ultimately the dividends. So one would tend to think we'll surely grow the 400,000 at 12% and then add back that interest after tax that we will not be paying beyond year 5. Now there's a problem with that. Because the interest is in fact fixed, it's not going to be growing at 12%. And so you actually need to add back the finance charge savings after tax. You need to go and work then with the 464,800 and grow that by 12% for 5 or 6 years. So I need to make that adjustment before I grow the figure. And remember, as I said to you, we can either grow the figure for 5 years, which is up to the point of conversion, or we grow it for 6 years, which is 1 year beyond conversion. Now, how will this differ then? Our approach is going to be different. If we take it to year 5, then we have at conversion a D0 dividend yield approach that we can use, because I'm valuing it using the dividends at that point in time. On valuation date, the dividend then is a D0 dividend yield relationship. And so the same would apply if we just grew the earnings to that point. Then I could use the same earnings yield. So I either use D0 at the dividend yield or E0 at the earnings yield, and I get a value for the shares there. Alternatively, if I grew the dividends 1 year beyond the conversion date, then from a valuation perspective, I am sitting with a D1 over KE minus G methodology that I need to use. And so you will see there at the bottom of your slide that that is in fact what I did there. So diluted D6, or diluted dividend per share 6, capitalized at KE minus G, gives me the value of the shares when? At the end of year 5, beginning of year 6. So it's the same point that the dividend yield would give you a value using dividend 5 over the dividend yield. Now, if I grew the earnings to year 6, can I use an earnings yield? And the answer is no. Because I've brought in 1 year's growth into earnings and taken it from year 5 to 6, I need to remove that 1 year's growth in earnings from the yield. And so listen carefully. If I take the 32.14% earnings yield and I multiply it by a factor of 1,12, it takes the earnings yield to a forward earnings yield, which is the inverse of a forward PE. And so I'm compounding into the rate 1 year's growth in earnings. And that gives me the 36%, as you will see at the bottom there, earnings yield. And that is, just to confirm, a forward earnings yield. Now, on the next slide, you will see what all of those indicators give me as a value per share at conversion. Now, please just check that you're happy with the comments in that comment box that I've given you there, but I did explain that carefully to you. So, valuing these shares at conversion gives me a value at conversion of R13.41 per share. Now, what is the problem? And that is little friend saying to you, shh, we've got a problem. What is the issue? The issue that we have is that valuation date is T0. It is today. I need to know what the value of those shares is, where we are saying it is valued 5 years from now at R13.41. What would the value be today? And so that R13.41 is at year 5, so an N of 5, a future value of R13.41. But what I per year do we use to convert that future value to a present value? And the answer is very, very simple. I am going to do the conversion using a cost of equity. Why not the dividend yield of 8.036%? And the answer is very simple. We grew the earnings from time point 0 either to years 5 or 6 by growing the earnings annually by 12%. We brought growth into the earnings and hence dividends up until that point. How did we factor growth in beyond year 5 or 6? By using a rate, either the earnings yield or the dividend yield or KE minus G or a forward earnings yield that are all growth adjusted in addition to being risk adjusted. And so the question is simple. Have I already accommodated growth in my value? And the answer is yes. And as soon as the answer is yes, if we then use a dividend yield or an earnings yield, we are double counting for growth because growth is already sitting in the value. And so I need to use only a risk-adjusted rate. And that is what the cost of equity of 21% would be. And so, ladies and gentlemen, I use that as the discount rate, discounting it over 5 years, and it gives me a value of R5.17 times 9 shares gives me R46.54, that infamous same amount as the other approach gave me. Now, that, please remember, is only the value of the equity. I need to now bring in the value of the debt component in this hybrid or compound instrument. How will I do that? I need to do a fair value of the future interest payments up until conversion. And so at 9% per annum on R100, it gives me R9 per debenture is what I would pay as the issuer. I would pay that for a period of 5 years, and remember that the fair value of this part of the instrument is, for the convertible instrument in total, we are saying that the debt portion here would relate to the convertible nature of this instrument, and so using the 10% here as a discount rate, the market-related rate, for a similar convertible debenture, I discount them. The R9 cash flow per annum over a 5-year period to a fair value of R34.12. That I add to the total value of the equity of R46.54, and so for all of the approaches, I get a total fair value for the compound instrument or the convertible of R80.66. That, in comparison to the R95 that we spoke about earlier, gives me the conclusion then here that for the holder it would be better to redeem, as they're getting more value from that. Should we have been valuing the debt component here from the position of the issuer, we know the issuer's tax rate then is 28%. As we are dealing with a solitary party in the market, I then am able to apply a single tax rate here. And so how would this change? The first issue that would change here is I need to adjust that to an after-tax payment, and I need to adjust the rate to an after-tax rate of 7.2%. And in doing that, we would calculate a value on an after-tax basis for the issuer, if the issuer had held the right to decide whether to convert or redeem. But we said here it is the holder that has the right. And so I apply a fair value on a pre-tax payment, pre-tax rate basis. Now, what I'd like you to please do, having listened to and watched this video, I want you to attempt a slightly more complicated, and it is probably one of the most complicated questions in question pack 1 on valuations. And that is a question called CD-ROM. I want you to read through it. I want you to try and identify your own triggers here. And then I want you to attempt the question. I will, in a tutorial, an online tutorial, discuss how you apply these principles around valuing a convertible to the valuation of the convertible instrument that forms part of the CD-ROM question. Right, as I said to you, it's a complicated question, but please remember you are not alone. I will provide the necessary support to you once you've read the question and you've attempted it yourself, because it is only then that an explanation will actually mean something to you. So good luck in trying to do that, and bingo, we are done. Thank you for listening. Please go and consolidate your knowledge now by applying in a very robust scenario the basic principles that we've discussed here. Right. And in closing, please try to understand all the approaches that I've dealt with in valuing the convertible here. Often people say to me, well, if I understand one of them, am I fine? And the answer to that is no. Because depending on the kind of information you get, that will impact on the approach that you will take. So you need to be flexible and be able to apply all three approaches in valuing the convertible.